Well, hey there, everyone. Welcome to Chart This with Dave Keller. I am your host, Dave Keller. It's a beautiful, classic spring Seattle day here in Redmond, Washington, here on Wednesday, May 6th. We got a high around, 64 degrees, I think is the peak we're going to get here in a couple hours, but it was kind of chilly. I've got a sweater on. Man, I love this kind of weather. It's a little too warm for us over the last couple of days. We did not sign up for severe heat in the Pacific Northwest, so back to some normal spring temps here, which is pretty welcome. Hope you guys are all doing well and hanging in there wherever you're tuning in from. If you are watching live on Facebook, LinkedIn, YouTube, and X, hey, thanks for joining me live for this chart-based discussion. Please take advantage of being live to ask questions all along the way. If you can drop a comment on any of those platforms, I can see it here in Market Misbehavior HQ. And if you're watching the show later on our YouTube channel, we're not counting you out. Please use the comment section on our YouTube channel to drop questions as we go. And we'll hope to answer one of your questions in our mailbag episode on Friday. Very much a risk on day. We've been talking about the risk on, vibe to the markets here over the last week or so, pushing above 7,000, following through above 7,100, 7,200. Today, we get our first close above 7,300. As the market goes onward and ever upward, as we like to say. Classic risk on behavior. You're going to note technology at the top of the list, but it wasn't just tech. Some of the cyclical sectors like industrials and materials doing quite well. Also, sectors that were lagging, things like defensive sectors like healthcare and utilities, energy, anything playing on crude oil prices, which are coming down. This is all based on, commentary and news headlines that imply that we're pretty close to some resolution in the Middle East. Certainly, that would be a bullish outcome. Honestly, I would be thrilled to kind of get past this phase, whatever it is, this, direct conflict in the Middle East phase, and get back to just thinking about normal influences on the economy. This feels like one big one-off situation over the last couple months, bringing a lot of speculation and a lot of uncertainty, getting back to kind of where we are in terms of growth statistics, in terms of breadth conditions, and in terms of this AI theme, I think would be welcome for now, as we've talked about, right? Good news from the Middle East means risk assets moving higher. That's the story today. We're going to go through the charts here and particularly some of the major market indications on this bullish Wednesday. We'll look at the heat map, and you'll note actually plenty of stocks not participating in the upswings. We'll focus a bit of our attention on the names that were not part of today's upward move. And then we'll look at some charts that I've hand selected. I do have a candle quiz coming up for you, so have no fear. Candle quiz is near. With that in mind, though, let's talk about the market conditions today. Through our market recap, the S&P 500 finishing higher by 1.5%. That's at 73.65. The Nasdaq Composite up 2%. The mid cap and small cap indexes all doing well. This is the first day in a while, by the way, in terms of themes, like below the right. I think the headline is market makes new highs. Tech is leading. That's kind of the standard playbook right about now. Let's go layers down, and that's the point of this show, is to really think about what evidence we learned. What did we learn that was new? I would say small caps lagging is a bit of a new wrinkle to this market. Small over large has been the story for almost the entirety of 2026. During upswings and downswings, small caps generally have outperformed. The Russell 2000 is better than the S&P and the Nasdaq year to date. But today you've got the Nasdaq far outperforming the small cap S&P 600 and the Russell 2000. So an emerging theme certainly to pay attention to. Volatility remains pretty low. It's actually interesting to see how much the VIX spiked in the afternoon. The S&P, surged higher through the entirety of the session. I mean, we kind of opened strong. We had a bit of a pullback midday Eastern time, but then after 1 p.m. Eastern, it was just lights out awesome for the S&P and the Nasdaq. But look at the volatility, which kind of mirrored it, right? Sort of weaker volatility, and then the volatility all of a sudden comes down midday as markets were selling off, and as stocks rallied in the afternoon, the volatility really started to heat up. So during the day, a bit of a high correlation, a positive correlation between stocks and volatility, which is, needless to say, quite unusual. Having said that, the VIX did pretty much finish where it started. We still have the VIX in the upper teens, just above 17. That's a low volatility environment. That tells you the options market are saying Not much to worry about just yet. Watch for a VIX spike above 20. I'm not seeing that yet. Looking at the bond markets, we are following the risk on playbook. And what I mean by that is, we've been talking about since the, initial hostilities in the Middle East, since that started to, evolve over the last couple months to where we're at now, we have seen some, short-term takeaways in terms of how the market reacts to positive or negative news flow from the Middle East. When there's, negative news flow suggesting the conflict is going to be longer, that hostilities may, re-escalate, that more, some, additional firepower is brought to bear. What's happened is stocks have sold off, bonds have sold off, rates have gone up, precious metals have gone down, the dollar's gone up, and that's kind of been the general playbook. On a day like today, we're getting the kind of new, risk on playbook, meaning good headlines, encouraging headlines out of the Middle East just in the last 24 hours. And we get the opposite. We get stocks stronger, bonds stronger, rates coming down, gold and silver coming down, crude oil prices coming down, dollar coming down. And so all of those things that I just mentioned basically playing out today as strong news headlines just get people encouraged that things aren't going to be as bad for as long as one might assume, or some have speculated. So bonds rallying today along with stocks. The TLT was up about 0.8%. That means rates are generally coming down. The 5-year yield is right around 4%. The long bond yield right around 4.95. The 10-year point, arguably the most important as a benchmark for a lot of different things, finished today around 4.36. So all of those parts of the yield curve kind of coming down today as bonds rallied. The dollar continuing to come off a bit, and that downtrend in the dollar has been in line over the last 6 to 8 weeks as equities have rallied off of their lows in February, March, kind of rotating higher through, that's not true, through April, right? The second half of April and improving. We're seeing the dollar continuing to come down. And so I do have a chart of the dollar compared to crude oil and gold, so you can see how that relationship has been fairly stable. So as equities are ripping to new highs, gold and silver also having a pretty awesome day. It's been a while since we've seen a day where the GLD is up 3% and silver's up over 6%, but that's basically what we observed on today's session. Crude oil, of course, feeling the optimism that the Strait of Hormuz is going to be kind of back and open for business, or that the disruption because of the closing of the strait, or the limited flow, basically that impact is going to be relatively minimal. As a result, the USO, which is a crude oil ETF, down about 7%. We can see natural gas prices and gasoline ETF all down as well. So metals, great. Energy, not so great. In the cryptocurrency space, kind of mixed, to be honest with you. Bitcoin actually spiked up almost to 83,000 earlier today. Currently trading just around 81,500. Ether prices actually down slightly. We've seen a bit of a risk-off move. So what's interesting is more recently, just in the last couple of weeks, we're seeing a disconnect where Bitcoin had been going up often on days when equities were going down, which is a bit of a head scratcher. Usually those have been more positively correlated. Now we have a day where the S&P and the Nasdaq ripped to new highs. Bitcoin and Ethereum both kind of trending lower over the last 6 hours or so. So, sort of the opposite of what you might assume, given what's going on here. All right, looking at the S&P sectors, technology continuing to dominate. That episode that I mentioned on yesterday with Jed Ellerbrook, he's a growth portfolio manager with Argent Capital, had a great, just a really fun time asking him questions about valuations, about technology, and some of his comments about how to think about the technology sector. I think you're really going to appreciate, particularly those kind of struggling with what it means that the XLK just continues to dominate. It's getting near 40% of our benchmark is just the XLK, to be honest, probably 30, 36, 38% at this particular moment. It's getting bigger. If you include, and this is a point that Jed made, if you include kind of technology plus, right, include like Meta and Alphabet from the communication services sector, if you include the big consumer names like Amazon and Tesla, which are arguably big technology companies, just bucketed under consumer, you're now over 50% of the S&P, just adding those four names back into the XLK. So, I mean, again, just services, particularly technology-related services, are dominating the returns. They're dominating our thinking. The XLK is the only one of the 11 S&P sectors really outperforming over the last 6 weeks. I mean, if you look at the charts, it's crazy to believe that, but it is absolutely true. It's the only sector where the relative strength line is going up over the last 6 weeks. That's crazy. Industrials getting in on the action today, though, up 2.6%. Materials up 1.7%. On the downside, only two of the S&P sectors were down. Energy, not surprising, right? Because crude oil prices are coming down. If the situation in the Middle East resolves, if there's some sort of like actual ceasefire where there's no more little snippety hostilities, and where the two the parties all start to separate and kind of go their separate ways, whatever that means. Expect energy stocks to come down quite a bit because that's going to be crude oil prices coming down. At this point, you're still around $100 a barrel. It's still pretty elevated, but the down move you saw in crude oil really powering energy to the downside. Utilities as well, which is interesting because all of this move in tech requires a ton of energy, and utilities have generally been like the growth, like the energy component to AI, right? It's like all the utilities, all the energy needed to fuel those AI data centers and everything, but they're not looking very growthy right about now. I think the defensive nature of utilities turning investors off, and that sector is coming down pretty good. Healthcare, by the way, also flat for the day. All right, looking at breadth over here, we have the New York Composite Index up 2-to-1 ratio. Stocks advances versus decliners. The breadth in the mid-cap index was actually the strongest today, 70% up to 30% down. But again, the S&P large cap with the best performance out of this basket, besides Nasdaq, also doing quite well. If you look at the New York Composite Index, that's the main breadth reading that I follow, 2-to-1 ratio, which is pretty good. So healthy breadth today, healthy price action, all good. NVIDIA at the top of the leaderboard of this group of magnificent seven and friends, these leading growth stocks. I don't remember the last time NVIDIA was at the top of the leaderboard, but it's been a while. NVIDIA up 5.8%, finally actually starting to show some signs of life, finally acting like it's a semiconductor name, because it's been behaving more like a software stock, kind of lagging behind the semiconductors. But today, actually finally popping higher. Alphabet and Tesla both up over 2.4%. And those are your others, strong performers. Broadcom, which has been a pretty decent chart, making new all-time highs today, but closing slightly lower by about 0.5%. Netflix, which continues to show why it should arguably not be on this list, lagging behind, but bouncing up after a number of big down days. Amazon and Microsoft both up a little bit more than 0.5% here. All right, we're going to get to the heat map here in a minute. I see plenty of comments and questions coming through on the different platforms, LinkedIn, Facebook, YouTube, and X. Thank you guys all that are tuning in on those different platforms. Please drop questions as we go if you're here live. And if not, if you're watching the replay later on our YouTube channel, welcome. Please drop a question in the comments section. We'd love to answer your questions, maybe on the Friday all mailbag episode. All right, looking at the heat map here, what's going on? So, I mean, what stands out to you? So, number one, I would say obviously a pretty strong day. I would say, I mean, obviously energy stands out as a negative outlier, right? And that makes sense, right? If you follow the headlines, not looking at stocks, what you would probably assume is growth stocks are doing well. The market as a whole is probably doing pretty well, and energy is probably getting clobbered because crude oil prices are coming down. And that's pretty much what we see on the heat map here today. So the XLE, that's all the red right there. Not surprising. And again, a lot of those charts have had really good runs. A lot of those charts kind of testing new highs, but those are based on the assumption at this point, the run already that we've seen in energy is based on the fact that crude oil prices continue higher and or remain elevated. For now, we're not seeing that. And so those stocks are going to be pulling back a little bit. A lot of those charts still not bad, I would say, on the medium-term, long-term time frame. In the technology sector, I mean, obviously a pretty good day. And we're continuing to see, names like AMD with strong earnings just continue to pound to the upside. Larry, thanks for watching. Semiconductors are indeed ripping, and their earnings are as well. And so that's the kicker, right? And this is in the comment with Jed, and thanks for the comment here. This is the comment with Jed that hopefully that episode is out tomorrow morning for you. Keep your eye peeled for that latest episode of the Market Misbehavior podcast. But what he and I talked about was just that it's not just that these. I mean, I think if you don't look at the information, if you don't actually read, or read summaries of these earnings reports or what these companies are actually saying, it's not, I think the narrative that I think many of us have been fed going into this earnings season has been, yeah, these companies are making a ton of money. The revenues are huge, but they're also spending a ton of money. And so the idea of companies growing a lot of earnings, but spending a ton to get those feels unsustainable, right? Our natural, and I think very reasonable reaction is that seems like way too much. And look at how much they're spending. And I even featured a chart last week that showed how much, like 4 big companies reporting earnings. It was like $500 billion or something, and estimated to be like 600 plus billion in 2027. So they're not lightening up. They're stepping on the accelerator with how much they're spending on AI infrastructure. However, the reality is, for whatever reason you want to decide is the reason, the revenues are huge, but the earnings are good too, right? So when you look at the revenues and you subtract out the expenses, kind of classic, income statement work, the final result, right? Your net income, right? Your earnings are pretty strong and going up, and the estimates for the growth in earnings are continuing to be upgraded. So companies like AMD are saying things are great. We had a great quarter. It's going to keep going back. Like our projection is to keep growing. Now, at some point, that probably isn't going to happen forever, right? I mean, and the market history is filled of these moments where it's felt like the good times are going to go on forever and the music's never going to stop. At some point, it naturally kind of gets overextended, and what happens is companies keep growing, but you can't have unlimited exponential growth. At some point, it just gets too much, right? Whatever that growth prospect is, you outgrow the model, right? And this is, and one of my favorite examples of this is like Apple with the iPhones. I remember at one point it was like, Apple's a phone company. And this is kind of pre-cloud being the main revenue source. You think it was like Apple's a phone company. They keep selling a ton of iPhones. The projections were like more and more iPhone sales. But like if you looked at the math, at some point, theoretically, you would run out of human beings that need a new iPhone. And you'd run out of human beings that want to replace their iPhone every year, and they can't just keep selling. Like there's just no one left. Like the math actually gets to that point when you get big enough, and so there are natural barriers to some of these growth. But what's happened with companies like Apple's, they've pivoted to other businesses, right? And they've been nimble and rotated, and that's what arguably great companies do. So for now, what you look for are when analysts that dig into these companies deeply, and when the management of these companies that know them better than anyone start to lower their expectations, when guidance starts to rotate, when earnings estimates start to be revised lower, that's when smart people that look at these companies deeply are saying, yeah, things are great now, but down the road, 6 to 12 months, we're seeing some huge barriers. All the stuff happening right now is not seeing that. Now, what happens naturally, if like everything continues in this kind of bull market environment, you would think that at some point, higher rates or, a stronger dollar, whatever combination of things starts to put pressure on things. That's why higher crude oil prices seemed like it could be one of those things. For now, the markets are telling you it's just not that big of a deal. When the market tells us it's a big deal, that's when we want to be concerned. So we'll keep a watchful eye on earnings estimates. And I've got, I talked to smart people like Jed Ellerbrook and Nick Raish and others that I've had on the podcast that really dig into earnings to say, hey, are you seeing anything that tells you there are warning signs we don't know about? And every one of them in the last month has said, no, things are getting better. So we want to own stocks. And so that's one of the many reasons why I'm sort of positioned for the market to go higher. And for now, it's going pretty well. Peter Lynch, one of my favorite quotes of his, it's what did he say? Something like, it's always a good thing to be caught with your pants up, right? It's sort of like his argument for always being fully invested. It's like, hey, I'm never ashamed market's going high, or I'm positioned for that. It's good during a bull market. And he made his cut his teeth in the 1980s, pretty decent bull market. All right, we've done digressing. What else? So I would say within technology, look, it wasn't all awesome, right? Broadcom down a bit. Now that's just coming off of new all-time highs. Arista Networks down 14% today. Salesforce down 3%. Cisco. So some of these are kind of slowing down a little bit. A lot of these are kind of that software group, which had been, a lot of these had been struggling, and some of them started to improve, right? Like Microsoft bounced off the lows. CrowdStrike is still one of those that I think is an interesting, play, kind of making a new 3-month high here this week. But if you look, it's a lot of the software names that are kind of struggling today. So it wasn't everything. It's semiconductors generally lights out awesome. And certainly a lot of the mega cap names there. And it's also the other sort of, probably could be bucketed under technology like Alphabet. Disney, which is an earnings name this week, bouncing higher about 7.5%, which is great to see as well. What else to highlight? And then I've been rambling too long. We got to get to some charts. I would say the strength in industrials and consumer discretionary and materials. Those three sectors are the other like standout things we want to pay attention to. Home Depot and Lowe's have been absolute dogs of charts. They're still not great charts, but they are bouncing higher today. Home builders are bouncing higher. So some of the groups within consumer discretionary that have been kind of the examples of what higher rates do, the disruption that they create in the kind of home builder, home improvement space. Rates kind of coming down now this week as investors are getting a little more optimistic about things. And some of these names like Lennar, is that a double bottom in Lennar? I mean, could be pretty clear support level, which I think is helpful. And then in the industrial sector, boy, a lot of things kind of rotating higher. The Caterpillars of the world have been in an uptrend for a while, but I'm excited about some of the aerospace names like GE, like that whole aerospace defense group. Boeing bouncing higher today. Eaton Corp is another kind of favorite great chart. Shout out to Northeast Ohio and Eaton kind of holding after breaking out. So those are some of the sectors I would say showing some strength outside of tech. So if you feel like your whole world is tech and that's all you can think about, there's some great charts elsewhere. I would encourage you to explore the entire heat map. What happens a lot of times for investors, you get your blinders on, you kind of think about one theme like AI, and then like that's all you can think about. Remember, one of the benefits of a heat map like this, you kind of see everything, and everything that's not an AI play, you can kind of see those components too. So don't miss that one. All right, we'll continue on here in a minute. I mentioned how earnings, I think, are driving things, and that comes with from conversations with really smart people. One of the smart people we interviewed recently was Alex Carto, who created a fantastic product called EPS Momentum. I used to work with Alex in our Bloomberg days, and I've kept in touch with him, and I'm really impressed with this new platform that they've released called EPS Momentum. You can find more info at marketmisbehavior.com/EPS. This has now become one of my kind of, it's in my Dave toolkit that I use pretty regularly. Every week, I'm bringing up this platform to look for stocks that score well in terms of price trend and earnings trend, all based on kind of tried and true and tested approaches to capture future strength or identify strength prospects showing strong trend and strong earnings potential. Marketmisbehavior.com/EPS will give you more info on that platform. And thanks again, EPS Momentum, for supporting Market Misbehavior. All right, let's finish off looking at some charts. I'll take a question or two. We'll call it an afternoon here on Wednesday. I had an awesome hike, by the way. I'm probably not going to go out today because I'm a little beat after that one. I went a little longer, but I was just kind of thinking, for me, getting out in the woods and just starting walking, all sorts of great creative juices start flowing. That's like the best thing I've ever done for my business is walk out in the woods for a couple hours. So it was an awesome hike, but I'm ready to take a break day. We'll focus on something else to clear our minds after the show. But an awesome hiking day. Always thankful for those. All right, here's the daily chart of the S&P 500. We're going up a ton, and I saw some comments in here about it's making you nervous that the market is going up this strongly, and particularly with technology in particular. I hear you, right? And I would say that is one of the most important and I would say toughest lessons I learned in my formative years as a trend follower was sticking with trends that feel like they've gone too far. Because I will tell you, the painful lessons I learned is something I'm sure all of you, I don't have your cameras on. You can raise your hand if you want. I'm sure they're up there. Mm-hmm. How many of you have had that situation where you have a stock that runs like 20, 30% and you sell your position and you feel like a rock star because you locked in those gains? And then you sit there sadly on the sidelines watching the price continue to go higher. I'm sure that has happened because it's happened to all of us if you've traded for any period of time. And so one of the benefits of trend following is you don't have to do that, right? You're not forced to sell when the stock goes up a little bit, right? You are allowed, you're given permission to stick with trends that work. And if there's one thing that is absolutely true about this market, whether it's an AI play or whether it's a consumer staple name like Casey's General Store, or whether it's a utility stock that just kind of consistently gets it done, or a REIT, uptrends can last way longer than you think they should, and they can bounce higher, and you feel like, oh my gosh, how far can this go? What I would encourage you, I think yesterday, I forget what name that was, where we talked about the channel. It might have been the semiconductor ETF, but or maybe Seagate Technologies. I want to say STX, right? One of those big long uptrend channels. The way you want to think about a trend, and I think this period back here, right, on the S&P, if you go back to like mid 2025, we drew this trend channel on here, and when you see like the market up here in late September, that is one of those times where you can say, oh my gosh, the market's gone way too high, way too quickly over the last 3 weeks. But it's like, yeah, but it's still within this kind of long-term trend. And I think what you want to remember is when we're up at the upper end of the channel, that's when it feels like it's gone too far. That could just mean it's time to get back to the lower end of the channel. And we saw all along that great bull market of 2025, these pullbacks, higher lows to kind of the lower end of this channel. So the S&P can come down quite a bit and still be within a pretty reasonable uptrend, arguably a very sudden and severe one, but still kind of be within the trend. So we're definitely kind of accelerating to the upper end of that channel. And even on like a weekly chart, we're kind of going to accelerate back up to the upper end of that channel. That might just mean maybe today's not the day when I initiate a bunch of new long positions, and maybe I wait for some sort of pullback, but it doesn't mean, oh my gosh, it's gone too far, now the markets have to go down. For now, the S&P 500 is making higher highs. This is why we look at higher lows. We look for the next pullback to make sure we make a higher low. Dip buyers coming in is one of the best proofs that the uptrend is still in good shape. That was one of the things we saw all through that kind of mid 2025 period. These pullbacks where buyers would come in and push us to new highs. We just haven't had one of those pullbacks in a long time. Arguably since the March low is the last time we had like a decent pullback. So it's going to happen at some point, right? One thing I will tell you, I will guarantee you the market will pull back at some point. The question is just how far we pull back, and do you see signs of accumulation? And that's why I would say the uptrend at this point, I don't see anything necessarily to worry about in terms of the long-term structure. Short term, are we getting pretty extended? Absolutely we are. Are we going to have a pullback? We absolutely are. Where that pullback goes to is something to pay attention to. Hey, the strength in this market is causing what we call the newer Dow theory, looking at the equal-weighted S&P and the equal-weighted Nasdaq. The equal-weighted S&P finally made a new 52-week high, all during this kind of rally where the equal-weighted Nasdaq is just blowing to new all-time highs. One of the things we had to say that we would say makes us a little bit skeptical, and we would need to see a breakout to validate the fact that this trend could go further. And one of those checks was the equal-weighted S&P finally making a new high. It finally did it, and it happened today. So we're finally seeing the S&P, the equal-weighted S&P, making a new high. I meant to show this the last 2 days, and I kept forgetting. I now had to put an exclamation point so I didn't forget to do this. Real quick comment on the VIX, and I'm going to show you a chart that Bloomberg put out. Might have been over the weekend that I thought was really interesting. A lot of people have been asking, like, with the market so uncertain, and certainly the market, sort of feeling like it's resolving to the upside here, but just over the last 6 weeks, the market conditions have felt very uncertain. How come the VIX is so low? How can the VIX possibly be below 20 when life feels so uncertain? When you look at the headlines, you look at the general configuration of these macro influences. The VIX for now remains in the low to mid to upper teens, which is still great. As long as we remain in the VIX kind of in this range, we're in great shape. VIX above 20 is where I start to get nervous. VIX in this range is pretty awesome. This is the chart I wanted to share with you. And again, Bloomberg published this a couple days ago, and I remember grabbing it. There is a VIX for the Nasdaq, and on VXN is the ticker that I've seen a lot. There's a VIX for the Euro Stocks Index, which is like a European version of the S&P 100, kind of. I mean, it's not exactly the same, but it's kind of like big stocks across Europe. It's sort of a good, general European benchmark, European large cap benchmark, better than anything, I would say. And I don't have V stocks here on stock charts, but I have reviewed it on other platforms like Coifin just to look at the data and validate what Bloomberg was publishing here. But they showed that from the moment that, beginning of March, right, and end of February, beginning of March is when, sort of the war with Iran really started to accelerate. Here's the spread between the V stocks, which is the VIX for the European benchmark, versus the VIX, which is volatility for the US benchmark. Here's the spread. It's significantly bigger, right? So the volatility has been in Europe, right? The VIX has remained fairly low. Basically, the volatility for the US priced in fairly normal, whereas the volatility for the European benchmarks has spiked. So if you look primarily at the US markets, which I certainly do, and I don't look at Europe a ton, but if you would look at those benchmarks now, you will find that the options market there is pricing in a lot more volatility. So the volatility is out there. It's just not in the US version, it's in the European version. And so that spread and just how the volatility is there, just not where we might have thought, I thought was a really brilliant illustration by the people at Bloomberg. So thanks, guys, for putting out a pretty decent histogram showing you where the volatility actually is. It's just not in the US as much as it's in Europe. Here's a chart of crude oil coming off a little bit. I do have a chart in a minute. I'll show you how that relates to the dollar and gold. But I would say what happened is today's drop did take us slightly below the 50-day moving average. We did close back above it. I would say breaking below the 50-day would be one of those signs that we're really starting to see a deeper downside rotation. The last couple of pullbacks, when we've had some good news out of the Middle East, have kind of gotten down to the low 80s, 84 here in March, 81, we'll say in mid-April. We got a little bit further before we kind of hit those same levels. So, I mean, if we do get a bit more of a pullback, that's natural. I would be looking for some support because the market's been telling us that's about where crude oil goes when things feel good. And then what happened here, we just had a acceleration of hostilities and then crude oil pop back up. So getting below that previous support, I think would be a nice indication that things maybe are actually getting better. At least the expectations are along those lines. US dollar, that's the top panel coming down here today. Dollar index is down around 98. So we're kind of in the range where we've bottomed out previously in April and earlier this month in May. Crude oil prices coming down, of course. $80 a barrel is that horizontal line that I'm highlighting there, just to show a potential level of support. Gold popping higher. So again, what's happening is the US dollar weaker, crude oil weaker. That's generally what's happened when we've had good news out of the Middle East. And then gold moving higher with stocks is what we've seen as well. So today's bounce taking gold, this is spot gold we're looking at, just around 4,700. And the GLD and the IAU, sort of those gold ETFs, bouncing higher as well. I mean, Bitcoin had kind of a choppy session, but overall still in great shape. We were kind of approaching the 200-day. It's kind of in play. Boy, getting above the 200-day moving average would be a fantastic sort of continuation of the rally that we've observed off of the February low. Those higher lows in late February and late March had us interested. The break above 75K was enough for us to start taking a position in our own portfolios, and we're holding on to that as we see this uptrend continue. Confluence of resistance right around 83 to 84,000 here. This is the moment of truth, Larry. I would 100% agree. Kind of right at that point, hitting the 200-day moving average. RSI getting right to that overbought region. I would be surprised, pleasantly surprised, being a holder of some Bitcoin ETFs if we just blow through these levels. I think a more reasonable expectation is we get a bit of a pullback, ideally to some sort of higher low, setting up the stage for a real emergence above the 200-day. That's kind of my general thinking when we're overbought, reaching a key level of resistance. That's pretty much a standard place where you'd expect a bit of a pullback. Do dip buyers come in on that weaker, that higher low? That would be the real question there. All right, let's talk about some individual names. I'll take a question or so and we'll call it a day. AMD gapping higher, right? I mean, the uptrend in technology keeps getting fueled by big mega cap technology names like AMD announcing earnings and saying we beat, great revenues, great earnings. And if you think that was good, wait till you see what we're planning for next year. That's been like the general script for most semiconductor earnings calls that I've been paying attention to. So AMD gapping higher another 19%. I mean, the market's just telling you that, these companies, the valuations are going up, but the valuations are justified. And for now, I'm seeing a gap higher. Anytime we have a gap like this post earnings, what happens next is vital. So Thursday, Friday, do we get the gap and run? Now that we've got like a 20%, upgrade on prices, are people willing to pay even more, 420, 430, 440 to own more AMD? That's what fuels further gains. If we have a gap and fail, or what we call a jump and dump, that would be bad, right? That would tell you, okay, the last buyers have now bought, and now we're starting to lighten up our position. But for now, a gap is pretty strong. These stocks are generally going vertical. It's not everything, right? Palantir, we highlighted this chart with kind of the very simple rectangular approach. This is basically a rectangle that encompasses most of the price action in Palantir over the last quarter. I think there's a pretty clear support around 125 and a pretty clear resistance around 160, 164. And for now, I think this is neutral at best. But compared to the rest of technology, I mean, getting absolutely crushed on a relative basis. Take Two is kind of an interesting technology play. This is bucketed in communication services. This is, Take Two is a video game company. If you remember, right, if you're wondering why Take Two is in communication services and not technology, what happened was technology was becoming a bigger and bigger sector. Eventually, the smart people at S&P looked at this and said, everything's technology, right? Every company is using technology, and the technology sector was becoming a catch-all for pretty much everything. So what they did was they took video game companies, entertainment names, media names, and grouped them with the telecom names like AT&T and Verizon and put them in a new sector called communication services. Happened about 8 years ago or so. And then they took the big internet kind of consumer companies, Amazon, and put those in consumer discretionary. So companies in all of the sectors, you could make an argument that they should be bucketed under technology. But you can't have technology be anything. I'm wondering if they start to address this again. Maybe we have a 12th sector at some point and start to peel off more off of the technology sector, because again, now it's getting closer and closer to 40% of the benchmark, which feels like a little much, but does speak to how important it is to the modern, certainly the modern American economy and the global economy. Take Two is a chart I wanted to highlight, though, and a couple of you mentioned top 10 charts. Yeah, earlier this week, I did my weekly show on Stock Charts TV. You can find that on their YouTube channel, and I highlighted 10 charts I thought were important to follow in the month of May. Take Two is one of those, and this is basically highlighting kind of technology plays that are not going vertical like AMD kind of earlier on in the breakout. And I thought Take Two is kind of an interesting breakout name above 220, sort of in this sideways trend between 188, 187, and then 220 on the upper end. We've just in the last week broken above there. We're now kind of testing that breakout level. I think that's a really interesting setup. The follow through above the 200-day moving average would be something I think that would really confirm this as a bullish trend. For now, I'm really impressed with it. All right, here's your candle quiz. Those of you that are hungry for that. Now, what's interesting is as the day went on, I would say the chart of Archer Daniels Midland, I think we shared this on yesterday's show or maybe Monday's. Earlier in the day, the current market was down around here, right around 76.50, kind of where my mouse is. So my question is, if we had closed down around that level, what would that pattern have been? So that's a big up day and then a lower open and a higher close, or a close above yesterday's open. So it's sort of like a big up day and a big down day, but instead of day two engulfing day one, it's day two is within day one, right? So the key factors are lower open and then like a bit of a higher close here. I'm stumping Market Misbehavior Nation. Dark cloud cover, Larry, is actually not correct. Dark cloud cover, we need to have a higher open. We need to have an open above yesterday's close. So key is we opened a little bit below yesterday's close. Bullish piercing line is something that would happen at a bottom. Bearish engulfing pattern would be if we had a higher open and a lower close. Yeah, this one's a tough one. Bearish piercing line, that's actually not a thing. Boy, this is a good one. Here we go. I finally did it. I finally stumped you guys. This is a bearish Harami pattern, right? So add that to your list of things you want to know. So what you want to remember is there's two kind of general, there are a number of big reversal patterns that can happen during an uptrend. You have a big up day, and if we have a higher open and then a lower close, that's a bearish engulfing pattern. If we have a higher open but a higher close, that's called the dark cloud cover, was another guess. If we have a lower open and a higher close, that's called a bearish Harami pattern or a bearish inside day. A lot of times people would call that. So funny quiz, because at the end, the market rallied. And I think that's an important lesson in its own. I often get people asking me about candle patterns like around 1 p.m. Eastern. And my initial answer to them always is, hold that thought, because we got 3 more hours of trading. You have to see where it closes, because that's an important factor to remember. And so at this point, it's none of those patterns. The fact that we closed up in the upper half of yesterday's range kind of eliminates it as any clear candle pattern. I would say at this point, it's just sort of a candle and continuing the range that we saw yesterday. I mean, the range was pretty close to where we were through the day yesterday, between 76 and 79. So overbought after yesterday's rally, down slightly today, but still kind of holding its ground. And I would say it was interesting to note how ADM, which looked like it was going to be a pretty bearish candle pattern at some point, kind of got less and less bearish as the day went on. Talk about a rising tide lifting all boats. ADM went from being a pretty negative candle pattern to being a not so bad candle pattern. The breakouts aren't just in technology, and I would highlight, and this was a note I did earlier today for my market misbehavior premium members, interactive brokers. IBKR is a good example in the financial sector of some new 3-month highs that I'm observing. I was going through the new 3-month highs list earlier today. A number of stocks in the financial sector, particularly asset managers like T. Rowe, BEN is another one, Franklin Templeton, Franklin Resources now, and IBKR, interactive brokers, also making a new 3-month high. This is just breaking above a swing high around 83. I think that's a pretty good breakout as well. Man, I did not think, Larry, I would come up with a candle pattern that got you. And I'm only calling you out because you have gotten 100% of those right, and you are the candle expert. And so I am thrilled that you are still learning candles, as we all are. Always be learning is something I was taught early in my career. And I'm so glad that we were all sort of in that boat together. Thanks so much, guys, for that. Let me take a question, and we will call it Michael. Thanks for watching. You said IGV. That's a software ETF. I actually didn't show that. I mean, I talked a minute about software, but not enough. Selling off again on a big update means software all will is and start selling off more. Yeah. So I'm summarizing your comment to say yes. I would say the narrative in mid-April was, it's not just the semiconductor names. Now it's the software names, because you saw all of these starting to bounce higher. And like CrowdStrike has been one of my, kind of one of my favorite examples of this sort of breakout. I would argue the chart of CrowdStrike is still pretty good, breaking out of a bull flag pattern, still holding the 200-day. But IGV is sort of a, software ETF, kind of stalling out here. And while AMD's gapping up 18%, software names are down a little bit. And so, there is a larger theme at work here, right? Where AI and software are kind of opposing forces within technology. We can't have AI that's so amazing that we don't need software anymore, and then software somehow monetizing all of that too. It's like both of those aren't going to work. It's like, and certainly the market has been telling us over the last 6 months, AI is the future, software is the past. I think for stocks like Microsoft, the question is, can they pivot away from a software company to all these other things? And they're certainly making a decent effort of it with the cloud services and all these other things that they do. But a lot of software companies don't really have that. So they are all desperately incorporating AI directly into their platforms. The question is, which of these names will kind of survive it? And you think of it in a lot of ways, like the COVID era, right? There were companies that were kind of in the right place at the right time around COVID. And then it was like, then the world kind of moved on, and which of those companies stayed on? Peloton did not remain a particularly awesome chart, but some of them actually navigated through that period, right? Zoom's is still a product that I use pretty regularly. So great example. And thanks for asking about software. Folks, we'll call it a day. Thanks so much for joining us. Those of you that did live, as always, great to look at charts with you. If you're watching the replay on our YouTube channel, make sure you drop a comment with any questions that you have. We're planning an all mailbag episode on Friday. Don't forget the Market Misbehavior podcast. Latest episode with Jed Ellerbrook should be your way very, very shortly. I hope you enjoy. Have an awesome night. Quick shout out to Tony. Thank you for that wonderful generous tip, and very clever. You tipped me in the amount of the closing value of the VIX. That is a meta sort of comment, and I appreciate that. Very, very kind and appreciated gesture. Have a great night. Remember, it's always a good time to own good charts. Take care, folks.